Hello everybody, my name is James Harries and I'm the manager of the Trojan Global Income Fund and Strategy at Troy. We recently won the Securities Trust of Scotland, also at Troy, which will be a closed-end vehicle which we'll take control of actually tomorrow. Many of you will be familiar with Troy, but it's worth remembering that the story behind Troy is that Lord Weinstock was a British industrialist who set up and ran GEC, which is a highly successful, very conservatively managed UK industrial. The coda to the story, however, is that when he relinquished the reins of the business, that it came into real difficulty and a lot of value was destroyed. And the lesson from this, of course, is that if you lose patience, discipline, and perspective, it can be very damaging to preserving capital. And when Lord Weinstock and Sebastian Lyons set up Troy, they wanted very much to ensure that this idea of having an eye to the downside, being conservative in your approach, and seeking to protect and then grow capital was what they were seeking to do. And the way we do that is by concentrating on high quality businesses, those with high returns on capital employed, running relatively concentrated portfolios that are invested with regard to the quality of the businesses in which we invest, but not with regard to underlying benchmarks, and to be cognizant of seeking to avoid those businesses where you may suffer permanent diminution of value. We're called Troy because of the 1979 Derby winner owned by Lord Weinstock. And on the right-hand side of this chart, you can see that investment trusts, closed-ends and vehicles, are core to what Troy does. We've had great success with Personal Assets Trust, and then Troy Income and Growth Trust, and now, of course, the Securities Trust of Scotland. They form the centrepiece of what we do at Troy. They're not off to one side as they are in some organisations. And we're very excited to be offering both an open-ended and a closed-ended structure in this strategy. Now, why do I say that patience, discipline, and crucially perspective is so important today? Well, on this chart, we're showing the world as it looked in 1981 under Ronald Reagan and the world as it looks today. Of course, this chart is already out of date, or maybe out of date. We'll see. But the point we're making is this. Back in 1981, it was actually extremely propitious time to be investing. We had much higher bond yields, much higher inflation, much lower levels of debt. Savings rates were high and could come down to augment consumption. Markets were, frankly, very good value. And the baby boomers, who've driven so much economic activity in capital markets, were relatively young. Of course, none of that pertains today. We have very low interest rates, low inflation, we have much higher levels of debt, much less attractive valuations, and much less favourable demographics. Now, so what, might you say? Well, the so what is, this is a rather less favourable backdrop. And if we ally that with a world where income is hard to come by, we think that a global income strategy managed along Troy lines, which takes this into account, which is careful about in which businesses it invests, and recognises that the backdrop is relatively unfavourable, should produce excellent risk-adjusted returns and dependable income. How are we seeking to do that? Well, I mentioned we want to invest in high-quality businesses. How do we define that? Well, businesses that have high returns on capital employed. We know that some businesses are inherently better than others, and one should concentrate your efforts, resources, and ultimately portfolios in those sorts of businesses. How do you identify them? Well, effectively, they have certain attributes, certain competitive advantages, which allow them to earn high returns for much longer than their peers and prevents competition coming in for a sustainable period. They often have similar attributes relating to brands, to distribution, to patents, to regulatory advantages, whatever it might be, being lowest cost producer, that enable these business models to generate high returns on capital. And once we've found businesses like that, we want to invest in with management teams that have demonstrated sound capital allocation in the past and are incentivized to have sound capital allocation in the future. And we're showing some of those businesses on the right-hand side. Now, you might all say this sounds very straightforward, but it is actually amazing how few portfolios in the industry are managed on this basis. But we're trying to strip it back to its absolute bare essentials in a way, in a sense of how is it that we're confident that we can produce risk-adjusted returns and sustainable income in a world where it's so hard to come by, where we've seen so many dividend cuts, both in the UK and elsewhere. Well, ultimately what we're looking for is businesses that not only generate high returns on capital, but also are able to grow. And if you find businesses that can do that, have a high return on capital employed, have a long runway for growth, have a high incremental return on capital employed, and that can do that without using a tremendous amount of capital, you will generate growing free cash flow. And what we mean by that is cash flow that can be distributed to shareholders, that can reinvest in the business to sustain those competitive advantages, and to therefore square the circle between having both high-quality businesses, which often trade at reasonable valuations, but also having a reasonable level of income. This idea of having limited capital requirements to run businesses is actually fairly core to what we do. Furthermore, you want to have very low turnover. So once you find these sorts of businesses, there aren't very many of them, and make sure you concentrate the portfolio in them. You want to allow those businesses to compound over time and try wherever possible not to interrupt that compounding. After all, the real money is made in the compounding of a quality settled portfolio and not in the continuous buying and selling of shares. So what sort of businesses do we favour? Well, we would mention we point out that many of them reside in the United States. And it reminds us, where possible, that perhaps one should have a global approach. Now, I would say, well, wouldn't I? But we do think that having the widest opportunity set you can, it has some merit. That if you are seeking high-quality businesses that are not too capital intensive and not requiring enormous amounts of capital, that narrows it down to a relatively small number of businesses, relatively small number of sectors, and makes us therefore very selective in terms of the businesses in which we invest. We are showing here some of the businesses in the portfolio currently, and we're concentrating on America, not because that's the only country in which we invest. We are global. But it is actually often we find the best companies, the best economy, and a lot of businesses that you simply couldn't find in the UK or elsewhere. So examples would be Microsoft, Paychex, and ADP, all of which are really high-quality technology companies. They're focused on enterprise IT, i.e. to businesses. Microsoft we're all very familiar with. It's an amazing business. It has exposure to all sorts of areas. It effectively owns the enterprise desktop, but also now has this amazing cloud business in the form of Azure. It's also in gaming. It seems to be it's remarkable, the sheer scale of what they're achieving, the sheer growth they're generating across a wide range of businesses, and clearly generating fantastic returns thereby. ADP and Paychex may be businesses that are slightly less familiar to you. They are well-invested outsourcing HR businesses. The desire to outsource your HR is stronger than ever, really, as HR needs become more complex. And to retain staff, having those HR needs outsourced can be a way of retaining talent, or perhaps on the downside, if you get it wrong, it can become a liability. These are wonderful, well-invested, unlevered, high free cash flow generating businesses with a long runway for growth, and you simply can't find businesses quite like that in the UK. Similarly, Medtronic and Johnson & Johnson, this is more in the healthcare area. You know, it's probably somewhat simplistic to say that healthcare will be a beneficiary of the ongoing global pandemic, maybe about to come to an end. We just heard the good news on the potential vaccine. But these are businesses where they've demonstrated that the science that they do is really very important. And I think the days of big pharma being seen as a bad thing as opposed to a good thing are probably behind us for some time. And these are two of the best. Medtronic is a well-entrenched, high-quality medical technology business, has a number of products and services which we think will generate high single-digit, low double-digit returns pretty consistently for many years to come. And Johnson & Johnson is familiar to many of us as both a consumer goods business as well as a pharmaceutical business with a rock-solid balance sheet. And finally, branded consumer goods. Clorox, P&G, PepsiCo, Hershey, these are businesses that will be familiar to many of you. Hershey owns half of the US chocolate market, and the US do like their chocolate. Personally, I don't think Hershey's chocolate is terribly nice, but it doesn't matter. It's a brilliant business. PepsiCo is 10 times larger than the nearest competitor in the snacking area. It's not really actually, people associate PepsiCo with Pepsi. It's really a snacking business. It's a fabulous business, and Americans, they do like to snack. And finally, P&G and Clorox both respectively make products that help you clean your house, that are everyday consumer durables that frankly form part of our lives. Clorox is a particular favorite of mine. It has a number of areas, has dominant positions in a number of niche businesses, which are benefiting from the current backdrop enormously. First of all, they make, whereas in this country we say Dettol, in America they say Clorox. It's the bleach that is now wiping every surface, it's cleaning every house, cleaning every hospital, and so on. But they also make charcoal, and grilling, as they call it in America, or barbecuing round the clock in gardens is becoming more prevalent. Cat litter, people are going to pets to gain comfort in these tricky times. trash bags, branded rather wonderfully, I think, Glad, and we're all generating more rubbish in our homes and so on. And what this is enabling them to do is to invest seriously in the business from these windfall profits to entrench some of these changed consumer behaviors and some consumers that are using Clorox products for the first time and in a more persistent way. And we think, therefore, there'll be, even though it won't be permanent, the current state in which we find ourselves, I hope so anyway, it'll be good long term for Clorox's business, we think. So I hope it gives you and finally, CME, Chicago Mercantile Exchange. This is a brilliant business. It owns the 5 biggest futures contracts in the world. And the remarkable thing about that is, whereas a normal stock exchange doesn't own the stocks listed on it, in a futures exchange, you do. They're your products. They're your contracts. What's interesting about CME Group is it's really a beneficiary of bond volatility and bond issuance, as opposed to most exchanges who are much more geared into equity markets. Now, clearly, bond volatility is very low at the moment, although it's gone up in the last couple of days. It's generally pretty low. But bond issuance is exploding because governments are having to fill the gap left by the difficult circumstance in which economies find themselves. So we put all that together. We were able to buy CME on a virtually unlevered 5% free cash flow yield, funding a 4% dividend yield, which reminds us that this business doesn't use very much capital to grow, consistent with what I was saying earlier in the presentation. It's really a software business. Microsoft, Paychex, ADP, and CME are all really software businesses. And I guess they're also a good demonstration that so much of the world is now being digitalized, and investing in businesses that benefit from that and avoiding those that are disrupted by that is a really important part of generating sustainable returns and income. You'll see on the next chart that all of this approach has led to relatively good returns, both relative to our peers, but of course notably relative to our UK cousins. I guess Troy's approach of being conservative, of having an eye to the downside, has really been demonstrated this year. Clearly we had rather a difficult time in March in markets, and we're pleased that across the business, but also in this fund, we did a relatively good job of protecting clients' capital, allowing us to continue to grow. We've always felt that if you do reduce the significance of drawdowns, it enables you to compound capital in an attractive risk-adjusted way. Yes, you can look a bit pedestrian when markets are shooting, and you can lag those markets as we are doing today. But over time, if you do reasonably well when markets are going up, but do well in protecting capital on the way down, over time you produce excellent risk-adjusted returns. And that's always what we've tried to do at Troy. I always think this chart has as much information as any about the fund itself. You'll see that we are generating a 5% free cash, slightly over 5% free cash flow yield, funding a slightly over 3% dividend yield. What you'd hope to see from a Troy portfolio is decent value and excellent quality. On the right-hand side of the chart, you can see that the underlying fundamentals of the businesses in which we're investing are far superior to the underlying market. So decent value, excellent quality, funding a resilient and growing income yield. Finally, we're going to talk about the benefits of a closed-ended structure. I mentioned we're delighted that we're taking on the management of the Securities Trust of Scotland tomorrow. And there are a number of benefits to an open-ended structure. Clearly, some clients prefer open-ended, some clients prefer closed-ended. We are clearly agnostic, but there are some benefits to the closed-end structure. The first is clearly that people like having board oversight in the investment trust structure. I guess it's worth mentioning that governance at Troy has always been very strong. We've always had very senior people on the board, and they've always exacted significant control over the business. Indeed, when Sebastian Lyon launched Troy, 2 of the directors were FTSE 100 main board directors when he was the only employee. It must have made for very interesting board meetings, I always think. But within the investment trust structure, that board oversight can give investors some comfort. We're also able to smooth the income via the revenue reserve. We also, of course, have the ability to gear. Now, Troy is generally a pretty conservative house. We invest both conservatively, and we apply gearing in our investment trusts in a conservative manner, as we can demonstrate both in Personal Assets Trust and Troy Income and Growth Trust. But it's an excellent bow to have in your quiver, if you like. It's an excellent lever to be able to pull. Should we see excellent value appearing in markets, we can apply a degree of gearing to augment returns and income for our investors. And finally, importantly, I guess, we are going to be putting in place a discount control mechanism, a hard discount control mechanism in this structure. And what this means is that because this provides liquidity and because it gives investors comfort that the trust will trade close to NAV, that somewhat counterintuitively, because you have liquidity to sell, people are much happier to buy. And therefore, it will provide liquidity and certainty to investors, and we hope, therefore, will give people confidence to invest in the trust. So that's largely what I was going to say. We think at Troy that more than ever, investing with perspective, patience, and discipline in relatively concentrated portfolios with low turnover to allow businesses to compound in inherently high-quality businesses should today allow us to generate both persistent and durable returns and income in a world where there is so much disruption, so much uncertainty, and so little income. So thanks very much for your time this morning.
Thanks for that, James. Just a few follow-up questions now. You've been managing global income funds since 2005. Has your process changed at all over that period?
I guess a little bit. A couple of the things that we've evolved in terms of the process over the last few years is the first one, that we've become much more quality focused. In a Troy context, we try and concentrate our efforts and our resources and our portfolios, as I mentioned in the presentation, into particular businesses and sectors that have certain attributes which allow them to generate high returns on capital employed and sustainable income. And that narrows down the opportunity set much more than a traditionally managed fund, which would be taking companies from a broader range of industries. The other thing is that we are trying to be much more long-term in our portfolios, in the sense that we have very low turnover at Troy, about 10% generally speaking across our portfolios, which means that the holding periods we have are about 10 years. Now, if you're going to buy a business for 10 years, you want to be really sure that it's a business in which you want to invest for the long term. And we are at Troy. And so those two things tie in, low turnover and a focus on quality. And I think, therefore, those are the key attributes that we've changed in the process over the years.
Has COVID resulted in changes to the portfolio? What effect do you think it's had on the economy and markets?
COVID's been a huge event for society and for markets. It's been a tragedy, clearly, for many people and for many markets. The direct impact it had on the portfolio is that in March we were able to buy a number of businesses, really high quality businesses that one doesn't tend to get the opportunity to buy very cheaply, very often. They've been in the universe for a long period of time, and we were waiting patiently to buy them. And these were ADP, outsourcing HR business I mentioned earlier in the presentation, CME, which is the Chicago Mercantile Exchange, and Intercontinental Hotels Group. Now, of course, that required us to be a little bit brave, because hotels are right in the center of everything that's been going on. But we view it as a really high quality franchise, a really high quality, it's really a software and branding business. They don't own the underlying hotels. They lend their expertise and their brand and generate really high returns on capital thereby. And we were able to buy it really cheaply, and it's done very well since then. So there were specific things that we did as a result of COVID that enabled us to upgrade the quality, the growth, and the income in the portfolio, which is the three things we're continuously trying to balance. The effect more broadly on markets and economies, well, we've clearly seen a big acceleration in the structural changes that were already really in place. So in areas like e-commerce relative to physical retailing, the move into electronic cars. We recently heard from a number of car manufacturers that consumers are pushing them to produce electric cars. And that's a really fundamental change to a business, and it has real implications for CapEx and for returns and so on. And frankly, the disruption that is taking place, the shifting in profit pools that are being generated by the digitalization of the economy and by technological disruption has been accelerated. There have been other features, obviously, which are potentially more short-term, relating to household goods and products and cleaning products, and to travel, to hotels. And we think all of these will dissipate over time. But some of them, the more structural changes, will persist. Clearly, we've also seen a big deterioration in government balance sheets as a result of what's happened. And that's something that we're going to have to be paying back for a long time.
Value has underperformed growth for an extended period. Do you think you should be selling quality companies in favour of cheaper assets?
Well, this is clearly a very topical question, given that we've seen a big rotation in markets and literally in the last couple of days. Once the vaccine, or the potential vaccine, was announced by Pfizer earlier this week, we saw a bigger rotation than we've seen arguably ever, but certainly in decades in markets. Now, we at Troy have quite a strong view on this. We don't think one should be heeding the siren call, if you like, of buying businesses which are low quality but look inexpensive. Because although they may be cheap, we think ultimately they may well be an expensive investment, because the returns you'll garner over the long term won't be terribly good. We would much rather stick to high quality businesses and to buy them wherever we can when they become available to us, as they did in March. and not offload ultimately high-quality compounding businesses that we can hold for the long term for less high-quality, cheaper businesses that we buy with the expectation of becoming less cheap and moving on. It's inconsistent with our really long-term process. It's inconsistent with our quality focus. And despite the divergence, if you like, that we've seen between winners and losers in the marketplace, we think, if anything, bar certain times when there may be rotation between those two, we think over time that trend will persist.
Turnover is very low in Troy portfolios. Why do you think this is important?
We keep turnover low for a number of reasons. I mean, the most important is that the lower the turnover, the fewer mistakes you make, and the longer companies have an ability to compound capital in a settled, unencumbered way, if you like, or undisturbed way is the word I'm looking for. And that, we think, is how you make real money, not in the buying, selling of shares. The other point of those, it's quite important in terms of how you think about investing capital in portfolios, because it enforces discipline on you. If you are going to hold a business for a really long period of time, you want to be really sure about that business before you buy it. Now, we have a universe of about 200 shares at Troy, which we use across our strategies: global equity, global income, multi-asset, and UK income. Each have a different emphasis, a different flavour, if you like, but they all have the same core holdings and come from the same core universe. And we think once you've found businesses that fulfill the criteria which you're looking for, which are pretty exacting, then don't mess around with it too much. Allow those businesses to compound, and ultimately, therefore, you have low turnover in your portfolios.
Have you had any dividend cuts in the funds this year?
We've had one dividend cut in the fund this year. Intercontinental Hotels cut their dividend. Actually, we think that's an entirely sensible thing for them to have done. The remarkable thing, actually, is that that business was cash flow positive, even in the depths of the troubles in March and April when most hotels around the world were closed, which demonstrates the real power of that business model. Even when times were really tough, because their capital requirements are so light, they were still cash flow positive, but they did suspend their dividend. This has been a global income company for years. Rarely do you get to buy it cheaply. We did. We think they'll re-establish the dividend and we can all move on. The only one that was suspended, rather than cut, was Domino's Pizza. This is a business we love. We're quite keen on pizza too, but we do love Domino's Pizza. We think that it's now got an extremely good management team, and it's clearly been a bit of a beneficiary of COVID, in the sense that turns out people like eating pizza in their houses when they're locked in. But they did suspend their dividend. The reason being because in a number of countries around the world, they were actually shut down. And I think they feared in this country they would also be shut down, whereas in fact what the government did is said they could continue to deliver. And therefore they've reinstated the dividend, albeit at a lower level, but we'd expect them to be reinstated more in the way that it was before COVID in time, and it remains an excellent business and a core holding in the portfolio.
And final question now, do you plan to use gearing on Securities Trust of Scotland?
To have the ability to gear an investment trust is a really interesting and arguably advantageous lever to be able to pull. Now, Troy, generally speaking, is a pretty conservative manager. We look to the downside both in terms of the quality of the businesses in which we invest and the way in which they're financed. And of course, that should run through also to the way in which portfolios are geared or not geared. And therefore, we won't use gearing structurally. We use it more tactically. And we will be willing to put in place gearing should we see excellent value in markets. We do have some gearing in the trust currently, which we think is fine and sensible, and will augment the income and hopefully the returns over time. So yes, we're happy to be able to use it. We see it as an advantage, but we are fairly conservative in the way that we apply it in Troy.